Welcome back to the Raw Selection Private Equity Podcast. Joining us today is James Carver, an experienced private equity-backed chief financial officer with 2 exits under his belt, both selling to private equity. He's going to share with us the lessons learned, the experiences he had during those exit processes. Jim, share with us a brief insight into you, please.
Thank you, Alex. So I've had a somewhat unique and interesting journey through the world of finance. Since graduating in college, graduated from John Carroll University in Cleveland, Ohio, was fast stock market and analyzing companies and thought that I wanted to be a portfolio manager. So my first job out of college was actually on a trading desk for a high net worth money managing firm, eventually working my way up to working portfolio managers at the company to kind of trend in that direction. However, growing up in the 90s, you had this meteoric rise in the stock. The internet was still really in its infancy. You had this new ability for individuals to actually manage their own money, which broke that traditional, stockbroker investor relationship. And there was just so much money flooding into the market. You had this internet bubble. With the time they kind of knew it was really, you had this internet bubble forming. And that coupled with, those who are old enough to remember the Y2K, all computer software was going to crash and the world was going to come to a technological end on midnight at the year 2000, which thankfully didn't happen. So shortly after that, I experienced, the late 1999 rise, early 2000 rise, and then the subsequent burst of the bubble, watching a lot of the Amazon.coms and the Microsofts and, a lot of the RFMD microsystems, a lot of those technology stocks either drop 90% and a lot of them, going out of business. And then right after that, you had the unfortunate events of 9/11, which not only impacted the market, but impacted, the global economy and just how we view things, in general. And it just compounded what already had really busted when that technology bubble busted. And then you had the subsequent Gulf War, which is a result of 9/11. So, watching individuals lose 30, 40, even 50% of their net worth based off of, no real bad investment decisions. It was just an unfortunate series of events that happened, really woke me up. And I decided that, I love the market. I love analyzing businesses, but, managing money really isn't for me. So I decided to go back to school and, try to get into investment banking and mergers and acquisitions. You think about mergers and acquisitions versus managing a portfolio of stock for an individual. There's a lot of overlap. When you're looking at an acquisition or you're looking at a stock to buy, look at Warren Buffett. You're doing very similar type analysis. You're digging into core fundamentals of a business and, the discounted future cash flows. What does that look like? How does that look like? So you had that same type of analytical prowess going on there, but it was a little different. It was corporate versus individual. So I went to Pepperdine University for my MBA. When I graduated, I went to work for a middle market investment bank based out of New York. But I was fortunate. I did a summer internship with them, and I actually joined 2 weeks after they opened their Los Angeles office. And at the time, it was just me and a managing director. And where most, summer associates and summer analysts spend their time, sitting in front of spreadsheets for 12 hours a day, I was actually able to get exposed to a lot of the financial community in Los Angeles as we were going out and trying to pitch the business to the private equity firms, the accounting firms, and the law firms. In fact, part of my job, in addition to working on deals, was to set up those meetings and accompanying the managing director to those meetings. So it was a very unique experience that I would say the majority of, interns do not have the opportunity to experience. After the summer, they asked if I would continue on during the school year, which I did, 20 to 25 hours a week. And then after graduation, went to work with them full time. After 3 years, got a little burned out of the grind as some bankers do, and went to work for a customer who was a nutraceutical manufacturer also based in California, doing two things really: supporting buy side M&A and supporting the CFO on FP&A, which comically and ironically enough, I had never actually heard the term before. So I was supporting with budgeting and supporting the manufacturing and all of the internal financial modeling. But it's funny, when I first started doing it, I didn't realize that was actually called FP&A. And so interestingly enough, after 6 months of being there, we ended up selling the business to an international strategic buyer that was looking to use our distribution channels to bring their product to the United States. So my primary focus switched from, being split between M&A and FP&A to just FP&A. And about 2 years after the acquisition, that CFO went to move to a larger company. It was a global toy manufacturer. He brought me over with me to be the director of a global head of FP&A. And this is really where I got a lot of exposure, and a lot of discipline around that FP&A function. Spent 5 years working with the CFO, reporting directly to him, working with the international finance teams, managing the budget, building financial models, and doing a lot of that day-to-day FP&A work. Um, After 5 years, I went to a smaller company looking to kind of get more into the build of a company. I wanted to get into a smaller company where I could have an impact and bring all those tools I learned in my 7 years doing FP&A for larger companies into a smaller company and help, drive growth. Spent 2.5 years in a LED manufacturer in Southern California, really professionalizing the finance function, raising some capital, working my way up. It was my first senior financial professional role. I was promoted to VP of finance. I was a de facto CFO. Unfortunately, the company hit some turbulent times and then ended up moving to Minnesota to take my first CFO job at a medical equipment distributor that also had a clean room division and an air compressor sales and service division. Um, Really professionalized the finance function and collaborating with the current executive team to help build the business. We built the business from, 25, 30 million to 60, 65 million over the course of 5 years. The business was an ESOP. And, for those of you who don't know about ESOPs, essentially i- over time you accumulate shares, and the longer you're there, the more shares you accumulate and the higher value those shares become. Every year you have to do a valuation, and over time, as the company grows, that valuation grows. So by the time I got there, you had a longer tenured employee base that had a meaningful amount of shares. And, through internal discussions, we felt the best way to monetize that was to actually sell the business. Interestingly enough, we were approached by a strategic buyer who was private equity backed. And this actually led us to my first liquidity event that I ran as the CFO. We started that process in early of 2022. We closed the transaction in July of 2022. I worked with that team on the integration. And then I had a recruiter reach out to me for a company in Charlotte, North Carolina, who was looking for a CFO. There was a portfolio company who had um, some struggling financial situation. So they brought me in to help clean up the financials and help lead the company and to turn around and take it through an exit, which brought me to my second exit. Spent the first 8 months working with the CFO, partnering with the CEO to help prepare the business, turn around the business, and get ready for an exit. Um, and then hiring sell side advisory, both investment bankers and Q of E, and then taking the company to market. We had a strategic buyer approach us in the spring of 2024, closed a deal in July of 2024, spent the next 8 months working with their executive team on integration. And then I decided to take a step back and do a personal and professional sabbatical, which brings me to where I am today.
Appreciate the insight. What's one of the mistakes that you see private equity firms or their portfolio companies making, and what would you suggest to correct them?
Not necessarily as much portfolio companies, and I think these two kind of go hand in hand. Um, I'll start off by saying, hiring a CFO without having the proper processes and procedures in place, or not planning to put the processes and procedure in place, and having that CFO end up spending the majority of their time digging into spreadsheets, you know, diving into closed processes, putting out fires on a daily basis. Obviously there's always going to be fires that need to be put out. That's part of the CFO's job. You know, this can be really corrected by building a standard operating procedure across the entire organization, starting with the finance function and surrounding yourself with good people that will allow you to focus on the more strategic side of the business. It also allows you to work with the functional area leaders. I know in some organizations that I first started out of, I walked into situations where the finance organization did not have very good relationships with the individual functional area leaders, and this just created problems around the organization because nobody understood what the left hand really didn't understand what the right hand was doing. And so building that operating procedures manual, working with the functional leaders, drives processes and procedures and creates a foundation to help drive growth forward. If you're a $50 million company and you hire a CFO and you don't have a good foundation in place, you could have the greatest strategic initiatives in the world, but they're never going to work just because people are going to be focusing on things that aren't, you know, strategic growth driven, and they're going to be trying to do too much. But if you can get them to focus on those 3 to 5 items that will drive growth and drive that strategic initiative forward, the company will be in a much better off place.
How have you typically come to which of the 3 to 5? Because I know when we look at constraint focus, what moves the needle the most, return on investment, what have you done that's allowed you to have the decision to have the data that drives the decision making that means you're on the right path?
So before you build the strategic or before you build the standard operating procedure, you like to map out the quote to cash process, and you like to map out the customer experience. And within that quote to cash process, you sit down with the functional leaders and you say, what are the key processes and procedures that drive the most, that maximize the customer experience? And what you can do is you can do that across all of the functional areas from the quote to the cash collection. And you look at those actions, you look at those functions that drive the best customer experience, so you can value, you want customers to spend the most amount of money they can, and it's the lifetime maximize that lifetime value of the customer, which, drives, ROE and ROI on your investments. So you kind of start big picture, mapping out the quote to cash. You take that as your blueprint for your standing operating procedures. And if you align that with your customer experience and which action items really align to provide the best customer experience, you end up driving that lifetime customer value up and driving ROI and ROE.
Makes sense. So let's spend this obviously a part of today diving into your experiences when you operated last two roles, as you mentioned, both went through to a liquidity event. So let's kick off with the kind of largest value creation projects that you worked on. Which were the ones that had the largest impact on the exit multiple?
Well, at NCI, we were a distributor. We had a clean room division, we had a sales and air compressor sales and service division. And so, the distributor business really made up about 35 to 40% of our business, and we really had no we had control to a certain extent, and it was really driven value creation was really driven by the relationship with the primary manufacturer, receiving territory expansion, hiring good salespeople. It was always key. Medical equipment is a very niche industry, and it's very difficult to find good salespeople, to understand the market, to understand the business. You don't necessarily you have to have almost of a science background that understands the functionality and how labs work and how that process works, also can sell. So, a unique mix of personality and talent around that. But a lot of growth came out of the clean room division. We had a very good head of sales who really drove that business. And it was identifying, okay, when is it key to hire somebody? What value, what sales level do you need to bring in another sales rep to be able to pass some accounts on so you can take and you can you can take on new customers. So because your sales reps can only take on so many customers at once. So we did a really good job at identifying those things from an operations standpoint, managing inventory better, making inventory more efficient, making shipping and receiving more efficient, making purchasing more efficient. We also did a buy-side acquisition. We acquired a bore scope inspection device. So it was a combination of organic and acquisitive growth that helped drive the business.
Okay. And you mentioned about the supply chain, the inventory. What specifically did you do to make those improvements?
We had a really good operations manager, and we worked on, taking the inventory management system, making the structure of the inventory area more efficient. So people, it was when I got there, inventory was really kind of mishmashed around. There was no logic behind it, and we really kind of organized it and structured by SKU and by customer, and it made things more efficient. We also had part of the challenging part about managing inventory, particularly for our air compressor sales and service, was our sales techs had vans. And so, figuring out ways to manage inventory on the vans because it's really difficult to track. So, we made sure, historically speaking, we never really did the annual inventories with the air compressor sales division. We made sure that, we always did periodic inventories on those vans to make sure that, inventory was tight and the very.
Sorry to interrupt. Just a quick mention of our long-standing partnership with Grata. As you will probably know, the private equity scene is constantly evolving, and deal flow is moving now to proprietary and data-driven processes. Grata provides you with the data and information of over 7 million private companies. So if you're looking to improve your proprietary deal flow and improve the data access, then reach out to Grata today. Now back to the podcast.
Chances were much smaller than when I got there.
And given the two exits, what were the lessons you learned from both of them that you wish you knew as you were approaching the first?
So interestingly enough, being a small private ESOP, we did not have any sell side representation. And so, we went into it, I had been in investment banking. I'd been through M&A before. So I had an idea of what the process looked like, but I had never gone through it by myself. Um, And, there was really nobody to kinda guide us through the process, me being a first-time CFO. The rest of the executive leaders had had sales backgrounds, and while they had some M&A experience because the company had acquired processes previous to us, you know, they really hadn't gone through the sale process before. So a lot of that was on me, and so it was me navigating blind, what to say, what not to say, how to position the numbers, how to position the story, and it was very, very, very challenging, flying blind, not having that third party guidance of somebody who had done it before. And while I had done it, the other thing I will mention, this is extremely interesting and unique to ESOP. So when an ESOP gets bought, there are two types of acquisitions. You can do either an equity sale or an asset sale. With an ESOP, if you do an equity sale, trustees of the ESOP can actually vote, and they can have a third party independent person validate the value to kind of keep, checks and balances in place. However, for an asset sale, all shareholders have to vote on the transaction before it closes. And so if you've ever gone through M&A, the most stressful thing is how employees are going to react. That post-acquisition first meeting to say, congratulations, guys, we've now been sold by XYZ. This had to actually be done 3 to 4 weeks prior to the close of the transaction. So not only were we managing quality of earnings and diligence, which really run up through the day of the close of the transaction, you now had to do people side of things, and you had to manage the temperament throughout the organization. Manage emotions, manage nervousness. Am I going to have a job? What's going to happen to us? and, reassure all the employees that this was best for the company. Thankfully, we had 100% approval on the vote of the ESOP. The integration went very well. Nobody lost their job. In fact, we actually ended up hiring some people. And so, that was a great learning experience. So going into the second acquisition, we did have sell side representation, which helped out a lot because you had those extra resources to help bounce ideas by, and you had people on site, and you could talk through things, and you could strategize, and that really, really, really helped position the company well to get through that a lot more smoothly. And it was somewhat less stress in the second one, because not only because I had been through one before, but we had that buffer between us and the sellers that they could kind of field questions and say, okay, and then come to us, and we, kind of strategize on how that response works. So, if possible, and I know it's not always possible because, advisors can be expensive. It's if you're going through your first sale, it's always helpful, especially if you're, in that 50-60 million dollar range where there's going to be a quality of earnings analysis done. It's always helpful to have some sort of a third party advisor kind of help you guide you through that process, especially if you've never been through one before.
Okay. And you also completed 5 acquisitions in your last role. Those range from revenues from 1 million to 15 million, so on the smaller side, which brings a lot of complexity as they're even less professionalized in the business you're in. What was the biggest challenge that you faced during that phase, and how did you overcome it?
The the biggest challenge that is always the relationship in easing the nervousness of the seller. And so, if you'd be we had a very, very good process in place. We had a gentleman who had, 20 years experience in the legal industry. He was our, quote unquote, shaking hands and kissing babies kind of guy. He'd go out and shake hands and talk to people, and he'd discover the businesses. And we had a template that we put together that he would use as kind of a foundation. Is this the type of business? Does this fit our core metrics on a type of business that we're looking for to acquire? And if fit all those criteria, then there would be an initial meeting with himself and myself. And that initial meeting was always, be as transparent as possible, and not only walk them through what the acquisition process is going to look like, but also walk them through what post-acquisition process is going to look like, how they fit into the organization, how their employees fit into the organization. And if you do that early on, you ease the pain of the, oh my God, everybody is going to lose their job. Because our investment thesis, we acquired businesses based off of the people and the business that they built. We weren't looking to buy businesses and replace management and bring somebody else in, because these were, smaller businesses whose the owners and the founders typically had a lot, were the face of the organization. And so a lot of times, we asked part of the sales tactic was to have them stay, over the course of the next 2 years or even further in the case of the large organization that we acquired, to make sure that, the business didn't go south. And so, that really, really, really having that starting point where you make them feel comfortable, make them feel welcome, and having them give you their input to make them feel like their opinion is valued, and they're going to have at the end of the day, you have to do what's best for the company, but always asking for their opinion, making sure they're a part of the process. And this isn't just, you're going to do what we tell you to do, and this is the way it's going to be. It's more of a collaboration between the owners of the business you're purchasing and us, and having weekly meetings, having update calls, and the most important being transparency. If you tell somebody you're going to do something, you know 3 to 4 weeks down the road, don't do something different. Things change unexpectedly, and that happens, but don't throw curveballs, or else you lose your credibility. But that relationship building, transparency, and getting the owners and the company involved early helps that post acquisition meeting with the employees, because they can champion the acquisition, and they can stand in front of the organization and say, "Hey, look, I've just spent the last 2 months working with these guys. They are truly a great group of guys, and you should trust them." And in fact, there were two of the acquisitions that actually chose lower valuations to go with us because of the way we ran our acquisition process, rather than be acquired by a larger competitor just because they did not like the way acquisitions were handled by them.
Okay. What particularly did they really like about what you guys did here that made you attractive?
The culture and the openness, and the fact that, we weren't looking to bring them in and just, say, "Okay, this is the way it's going to be, and you're gonna do it our way." And, it happened, a lot of times you acquire a business and they do things better than you do. And there are times when the larger company, despite the fact that the smaller company does things better, they're gonna make you adopt their ways. One of the things we like to do is, if you're doing something better than us, why what are you doing? Why are you doing it? Maybe that's something we should adopt on our side, instead of having you say, you're gonna do things our way. If you're doing things better, what let's take a look and see the way you do things. Is there something we can change on our side to make, the combined organization, better? So it was the culture, it was the fact that we embraced their culture, and we embraced their company, and we didn't really bring them in and say, "Hey, look, you're gonna do things our way, just get out of our way. We're driving the bus, not you."
Okay. What are the things you read, watch, listen to that you recommend others check out, please?
I'm a big Wall Street Journal guy. I read the Journal every day. I still think it brings a lot of value. They do a good job covering the news. I've worked in hybrid jobs, and I also like to listen to market news on television. I'm a big CNBC fan. I usually like to have that on in the background just to hear from a macro standpoint what's going on. I still have that love for the financial markets, even though, while I'm not I'm indirectly still involved. I still like to know what's going on, interest rates, commodities, oil, those things all drive businesses, and knowing what's going on a day-to-day basis, can impact your business depending on, if you're a manufacturing business that relies on precious metals are up, you know, how many gold, silver up in a extreme amount over the last 12 months. And so, being able to listen to what the markets are doing on a real time basis, really helps educate yourself and keeping you on top of what's going on.
Perfect. And if anybody wishes to reach out to you post this podcast, James, how best they get in touch, please?
My email is Jim underscore Carver 59 at yahoo.com.
Perfect. Well, Jim, thank you very much for coming onto the podcast today, sharing all your insights from your two private equity backed exits and the journey that you went on with both of them. Appreciate you coming on the podcast.
Well, thank you for having me on, Alex. It was a pleasure.
And as of course, thank you very much to all our listeners. Till the next time, keep smashing it.